This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Alright, this lecture is on the third chapter of the lecture notes, which is headed up Strategy Formulation. And yet again, this chapter is, with one slight exception, is really background knowledge and revision of previous papers. And please don't get the impression that the exam is all written. There isn't that much writing in the exam. Most of it does involve calculations, and we're coming to them in another couple of chapters. But you do need this background knowledge, and so I'm trying to get rid of it, in a sense, first, before we go into all the detailed arithmetic. Anyway, this chapter, really two, I suppose, related things. One is just talking about basically how they go about formulating strategy for the directors, and analysis of past performance. As far as business planning is concerned, you should be aware right back to the very first ACCA papers that there's really, we talk about three levels: strategic planning, tactical planning, operational planning. And strategic planning is making long-term decisions. Should we start producing a new product? Should we set up an operation in a foreign country? That sort of long-term decisions. And those plans, those decisions are made by top management. Once we've made our long-term decisions, then we go to tactical planning, and tactical planning is a bit more short-term, but making sure that we can actually achieve, or how we're going to achieve, these long-term decisions. We've decided to open an operation abroad in a foreign country. We've done all the long-term planning and decided it's worthwhile. We now need to look in more detail short-term, how we're going to achieve it. The budgets that companies prepare generally once a year are an example of how we're moving towards those long-term aims. And finally, operational planning, the day-to-day planning. How many are we going to produce today, and that sort of thing. So all of that, sorry, I haven't written anything down there, but all of that, so much by way of background, but things you should be fully aware of from the earlier exams. The other bit, though, in this chapter, financial analysis. It is possible, it's not very common, I must admit, in this exam, but every so often you could be presented with some extracts from financial statements for previous years, or forecasts of future years, and asked to comment on where the company is doing well, where it's doing badly. Now again, it's something that you should have done before in several earlier papers, looked at various financial ratios and so on. And I say again, it's not something that's very common in the advanced financial management exam, but it can be there, and so there's no harm in doing a little bit of revision. And here, rather than talk through it all, because you really should have seen this before, that, you'll see on the second page, halfway down, there are really four areas we could be asked to comment on. The profitability, obviously we want the company to be making more profit. The liquidity, has the company enough cash to continue operating? The gearing, what's the level of debt borrowing in the company, long-term borrowing, and investors' ratios, things like earnings per share and so on, the ratios that shareholders are directly interested in. And I have listed all the standard ratios on the third page. I have no intention of going through them one by one, because all of those you should have seen before, and I'm going to illustrate with an example shortly. But there are lots of ratios we can look at, and most ratios don't mean very much on their own. Return on capital employed. If you've forgotten what it is, we'll check shortly in an example. But if I tell you with the return on capital employed is 20%, is that good, is that bad? We've no idea. Most of these ratios are only relevant if we're comparing, is it better than last year? Is it better than similar companies? But as I say, on their own, they tend to mean very little. So you're looking at trends and comparisons. However, rather than simply talk through all these ratios on the third page and the fourth page, when they are revision, what I want to do is go straight to, I think it's the fifth page, which there's a heading there, EBITDA, which again you should have heard of, but it's earnings before interest, tax, depreciation and amortisation, which is quite a common measure that people look at often when they're looking at the company's financial performance. They're interested in the earnings, obviously. The higher the earnings, the better. It's earnings before tax, because tax is out of our control. You know, if the government puts up the tax rate, doesn't mean we've performed any worse. Nothing we can do about that. So in earnings before tax, it's earnings before interest, because we want to see how well the company's operating. Clearly, their operating profits will be distributed to shareholders, to lenders. But regardless of who it's going to, we want the company to make more earnings before interest and tax. And finally, though, the DA, before depreciation and before amortisation, is to make it a bit more of a cash measure. You know, things like depreciation. All right, it's an expense, it'll mean less earnings, but the level of the expense depends on the method of depreciation that they're using. And it's not a cash flow, it just depends on the company's policy. So, look at the EBITDA, the earnings before depreciation. It's more looking at towards what we might call a genuine cash profit. However, having mentioned those ratios before that you should have seen, and EBITDA, which you've probably heard of, and accepting this is not common in the exam, but could be a small bit of a question, just look at example 1. In example 1, I've given you summary financial information for Repsy plc, covering performance over the last 4 years. And you'll see the first 2 sections are effectively the income statement, the revenue, the turnover, cost of sales, salaries, wages, profit before interest and tax. Year 1 was 8,700, although these I haven't written would be in millions, you know, so it'd be 8.7 million. There's interest, tax, profit after interest and tax. So there is your statement of profit and loss. I've said what dividends were paid. And then you've got extracts from the statements of financial position. Average debtors, average creditors, average net assets, shareholders' funds, long-term borrowings, long-term debt. And then the last bit of information, number of shares in issue, P ratio, both for Repsy and for the industry as a whole. The increase in share capital was a result of a rights issue, whereas if you look at shareholders' funds, from year 2 to year 3, it shot up enormously. But again, we're told it's because there was a rights issue. And the question says, review Repsy's performance. Now, for the third time, to be asked that as a whole question in this exam is virtually impossible these days. Because again, it's something you should have done for what? bits of this you should have already been examined on in 4 different exams. And so to ask again at this level in detail would be ridiculous. But bits of this certainly could be important, so I'm not wasting your time. But rather than just listen to me talk through it, I'm going to split this lecture into 2 parts. I'm going to stop this lecture now, and I want you just for 5 minutes or so to see if you can list 5 or 6 important indicators as to how the company's doing. Is it doing better? Is it doing worse? And the reason I'm doing this is that it's no good if something like this does get asked in this exam. It's no good just coming out with an enormous table of every single figure, every single ratio you can think of or you've ever heard of. The majority of marks for something like this would be on your comments. This looks as though we're doing better, this looks as though we're doing worse, and for being able to identify the most important features. And so I beg you, rather than just go straight to the second part of this lecture where I will talk through it to an extent, please spend, even if it's just 5 minutes, jotting down somewhere, let's say, just 5 points, but what you consider the 5 most important points on that information that are indicators of whether, in each area, whether they're doing well or they're doing badly. So please, in your own interests, I say 5 minutes, that's all. Have a look through, have a go, and then look at the second part of this lecture. I'll go through what I consider to be perhaps the key points. But 5 or 6 points, that's all.